The margin of safety is another CVP analysis that's very critical for businesses. Margin of safety, if you think about it, is kind of like a safety net. It tells you how much you can be wrong by and still become profitable, at least break even. So this represents the volume of sales that can be lost before the company begins to lose money. This can be calculated in terms of, again, units and sales revenue in dollars by finding the difference between the sales and the break-even point. So putting this into an equation, it looks like this. You have the margin of safety equals the sales minus the break-even point. Now, the sales can be done in one of two ways, depending on where the business is at the point in time of its life cycle or what the accomplishment they're trying to do with the margin of safety. The sales can be either current sales or it could be projected sales, what they think they're going to sell in the future. Now, let's look at an example of margin of safety. Assume the company has the following income statement and wants to know what the margin of safety is. So again, same setup. We're at 25,000 sales, net operating income of 10,000. So let's look at the margin of safety. The margin of safety's equation is sales minus break-even point. Now, we need to know the sales, which is 25,000. It's given to us. We also need to know the break-even point, which we can do that very quickly. We know it's FC, fixed cost, divided by the contribution margin ratio, because we want it in dollars. So it's going to be 5,000 divided by 0.6. That's going to give us 8,334. So subtract that out of the 25,000. That's going to give us a margin of safety of $16,666. Now, what does that mean? Well, that means that our sales can be off by that amount, that 16,666 can be off by that amount, and we still break even. We're still, anything higher than that amount that we lose, we're still in the positives. Anything that we're off by more than that amount, we're now in the negatives and we're starting to lose money. We don't want to get there. Now, this is a margin, much like contribution margin, where in order to analyze this, in order to interpret this, you need to have the context. Because if we're talking about a car company and it says that we can only be off by $16,666 before we're in the red, then that means that we could be off by a single car. So, but if we're something that's sold very cheaply, like a bottle of soda, if we're off by that much, we can be off by a lot of sales. So you need to have the context of the product in order to really be able to interpret margin of safety more accurately. Let's turn that into the margin of safety ratio, which is the next one. As we've talked about before, the ratios are kind of, they give us a little bit more information with less the context that we need. This represents the percentage of sales that can be lost before a company begins to lose money. So this puts it in a percentage. It doesn't matter what you sell. It doesn't matter if you sell cars or you sell bottles of soda. This just puts it in a percentage. So it just gives you a better outlook minus all the context that you have to have with just a simple margin. Now, the equation here is going to be the margin of safety ratio equals the margin of safety, which we were just talking about in this video, divided by the sales. So let's look at this one, and the sales could be current or projected. Let's look at the example here. Same example, but they want the margin of safety ratio. So we know the margin of safety ratio is the margin of safety divided by sales. We already know the margin of safety because we just calculated that. That's 16,666 divided by the sales, which is 25,000. That's given to us. And when we do that, we find that the margin of safety is 0.67, which means that we can be off in our total sales or our projected sales by 67%, and we still be okay. We're still breaking even. So that's the importance of the margin of safety and the margin of safety ratio.